You're tuned in to Agriculture Today, and we start our Friday show with a grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, as we look at the grain market, May futures contracts currently in delivery, and how is that impacting futures?
Well, largely the elevators, grain elevators, other buyers of grain have rolled over their cash basis calculations or cash bids onto the July contracts rather than the May contracts. And uh, you see you see it particularly in corn here. We've got both the May and July lead contracts for corn, the delivery contract for May, the lead with the July, both down three and a quarter cents. All the other contracts either sideways to higher. So you got some movement there occurring. Now you don't see the same type of activity on soybeans, although for wheat, with May 25, that May 2025 contract in delivery, you see a bit of for yesterday at 516, actually up 1 3/4 cents, and then July down 2 cents, and going thereafter. So yeah, that's just the reality of the market, and so that's likely to cause some. I guess we'll be watching basis charts to see what impact that rollover may have on things. Overall, though, generally been a time where there hasn't been a lot of excitement in the grain markets. Crops generally getting planted, some rain forecast, uh, not not a lot of things to threaten the crop yet. In fact, we've made some pretty good progress in the field. You've got for the corn crop in Kansas. We're as of April the 27th, we're 39% planted according to the USDA NASS survey, and normally we're about 29%. So strong pace there of the crop getting in. And again, you do that when you have generally open fields, not a lot of moisture over the whole area. And for the U.S. overall, we're 24% planted for the corn crop up over the top 18 states and normally about 22. So well on pace. Even soybeans coming in pretty strong. You've got the Kansas soybeans as of the 27th of April. Again, 13% planted ahead of pace. Normally, last 5 year average are about 7. And for the U.S., 18% planted overall for the top 18 states, 12 normal. So moving along there. And really, even for wheat's not being planted in Kansas, but we're looking at development of the crop. In Kansas, we're 19% headed for the Kansas wheat crop on as of the 27th. Normally, we're about 10. And again, these you get this type of strong pace when you have generally open weather and the opportunity for things to move along. Other than that, as you mentioned, the futures still strong carries in the wheat market. We've been talking about that the last several weeks. A strong signal towards storage. That what catches probably most Kansas farmers' attention, though, would be the level of prices here. That for the May contract, again, now in delivery, 516 was the close yesterday on May 1st, 527 and a quarter. And For the July contract. And again, you're looking at break evens, especially for any crop out west, that any wheat crop out west that would have a fallow period in it, a dollar more higher than that. And even in central Kansas without the fallow, we still need strong yields, 50, 60 plus to have prices at 527 futures with any type of negative basis come near covering full economic costs. Again, we're covering cash costs well, but it's the full economic costs that we need to cover to have machinery lines, any land payments, and family living all covered going forward. So you've got all that happening, and so in the midst, especially of the wheat market, harvest coming on, we're seeing pretty slow cash wheat prices with again top prices now in all these areas all below $5. The highest price is 496 in the Salina, Topeka, and Hutchinson areas, and closer to 450, 460 in the western part of the state, southeast down 463. So that's the cash prices we sit right now heading off into harvest. Still have that situation where the cash wheat prices in southwest Kansas are less than the cash corn prices. They're showing that top prices in Garden City for wheat at 463. The top price for corn at 472. So the wheat price less than the corn price. What's stood out to me in the last week, though, in the Garden City area, which had been running about 10 cents over as a basis, even even in the Garden City area where we have our demand center, now the basis for that top bid is now 7 under. So that's saying something for us here when we're not worried about corn production to the degree our corn supplies in local area that we see that the basis in Southwest Kansas at the top locations actually turn negative. So that's just indicative of where we're at. I would say that um, when you have times like this, it's worth looking at what low price times might give you, especially in the options market. We don't talk a lot about options. I know those long-term farmers in Kansas remember Bill Tierney. Bill really spent time, hung out on the options market to look to see what puts and calls could give a person for opportunity. And let's just take a quick look at corn and see if there's something there. So here, July corn closed again 472 and a quarter on Thursday. D's corn for new crop bids 447 and a quarter. When you look at what a put option, which is basically the opportunity to protect yourself on the downside in corn futures. Again, for $4.47 D's corn, if you went and bought a $4.50 put option, which is protection from prices falling, you'd be at it would cost you about 33 cents and a few cents to deal with a to work with through a broker, etc. So 450 minus about 30, say 35 cents, 36 cents, you're down to 415 or so. And what's telling to me when I start looking at the options to see where people have spent their money, what are they protecting against? And that you see a lot of open interest at about $4. So there's a fair number of people, a lot of folks, uh, basically 24,000, well, about yeah, 24.6 thousand contracts times 5,000 bushels of contract of people that have bought protection at $4. So that's protecting the low side of the market. And you do see all the way from $4 to 450 again. Uh, 16.7 thousand, 15.9, 14, 12, 17, 18,000 contracts bought at all along in there. So there's a lot of folks that have come into this market and have protected themselves on the downside. Not that many that have, well, and there are some folks that on the other side of that, there's still risk that things could go higher. And cattle feeders, ethanol plants, they would be interested in buying call options to protect from prices running higher. And really, if you start looking at where people have bought their risk at in these markets that can still jump all over, we can jump. It's still possible to go to $4 or below. It's still possible to go to $6 or above. That we're just on May the 1st. But if you look at the corn markets and you look at the $5 call options, there's about 33,000 contracts that have been bought for calls at $5, which means that they'd be in position to benefit if prices went higher. And again, so who would do that? Well, anybody it's got to buy corn later on, or there might be some that have sold cash and bought call options to be in position in the futures to let things run up. So just thought provoking. I know we don't normally talk about that, Shelby, but just wanted to mention it. And for soybeans, one thing I would say for corn, still strong export usage for corn. Low prices bring about demand, and that's so we've been moving a fair amount of corn and seeing saw some movement for sorghum last week. Still just sort of normal. When we look at exports for wheat, actually we had a strong wheat uh, uh, wheat wheat week, I guess. Pardon me, 7.7 7 million bushels, one of the highest in several years in terms of a week of movement. And why would that happen? Well, wheat, hard red winter wheat out in our part of the world, it's just as we were talking about. Gosh, prices below $5. It's a buying opportunity. So we've seen buyers come in and some movement happening, uh, and um, so you, uh, if that could continue, that would be good. But what it's saying is that we're getting around low enough in the market in not just a U.S. sense, but an international sense here in the U.S. that it's attracting people. So attracting buyers in. So we'll see where that goes. And for soybeans, we ended up and really of these commodities between corn and wheat, hard red winter wheat and soybeans have probably held up the best. And in fact, you see that on yesterday's close on May the 1st. Actually, soybeans up about 6 cents across the board, and the other two major futures we're talking about struggling some. And still have a pace of exports about 21, 22 million bushels for the week ending the 20 on April the 25th. Need a pace of about 13 to meet the USDA's projection. Of course, we're looking right at a whole bunch of South American soybeans just about to come, but we're not that far from meeting the USDA's pace, and a little bit weaker U.S. dollar helps the cause. I would say that as we were talking about some what the market is telling us with regard to buying opportunities, or how it values the risk in the market. Here you got November soybeans closing yesterday at 10.24. You look at that November contract. If you were going to go in and buy a 10.20 at the money put option, and I know here that would basically think price insurance on the downside. Okay. Uh, and most ag producers, they're used to hearing this terminology. Anyway, so $10.20, and you said, okay, I want to protect myself from prices dropping below that, and that would cost you in the market about 52 cents. That seems pricey. So to protect $10.20, you spend 52 cents. But in so many words, they're worried about prices going below about 9.70. That's the signal that they're giving, and by far the in terms of where the money is, where most of the volume is at. You look at 940, 1020 as places where you see that, where you see puts being bought to protect the downside. On the upside, who would buy calls in the options market? Well, soybean processors would be people that would do that. And most of where most of the volume is at on that's about around $11, 10.80. So those folks worried about what could happen to drive prices far above $11, far above 10.80. So it's just interesting and helpful, I think, to as farmers try to gauge where the movement in this market could be at, to see where these commercial buyers, where they place their money at, what are they worried about. And with those many contracts in position, they're still thinking, gosh, it's May 1st, but we've got to get through June 1, July 1, August 1, and still anything could happen as we get out in the summer. And maybe the moral of the story is stay tuned. We'll see what weather does over the next 60, 90 days, and we'll just hang on. And if we have great weather, well, you'll take us to the lower side in the markets, but that outcome is not assured.
Dan, I appreciate you taking this time to join us today.
Thank you very much, Shelby. Take care.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now, but we'll be right back.